Plug Power is currently trading at $3.17 as of May 2, 2026. This reflects a significant intraday pullback following a very volatile week, where we saw the stock jump and then immediately retreat from a local high of $3.47. Even with today's sideways movement, the stock is holding on to a decent portion of the gains it clawed back from its March lows of $1.72. The volume is steady, but there is a clear tension in the air as we approach the May 11 earnings call. Most investors are looking at these numbers and seeing a company that has finally found a floor, but the reality is much more nuanced than a simple technical bounce. While the headline price suggests stability, the actual market activity reveals a heavy hand of institutional repositioning. We are seeing a massive tug-of-war between short sellers who have dominated the narrative for 2 years and a new wave of aggressive options traders betting on a massive squeeze. If you look at the recent call option volume, it spiked nearly 31% above the average recently, suggesting that a subset of the market isn't just hoping for a recovery, they are positioned for a violent move upward. This creates a fascinating curiosity loop, because the common belief is that Plug Power is a sinking ship, burdened by dilution and endless cash burn. The expectation is that they will eventually run out of runway. However, the reality hidden in the recent 275 megawatt contract win in Canada and the asset monetization deals suggest a management team that has stopped trying to please everyone and has started focusing purely on survival through industrial scale. They are no longer just a fuel cell company, they are becoming a utility-scale infrastructure play. This shift in identity is something the broader market hasn't fully priced in yet. When you look at the Schwab Intelligent Portfolios or other automated investment services, they often categorize these stocks based on historical volatility and sector risk. But for those doing self-investing or looking for investment help on more niche investment sites, the real story is in the pivot toward being an integrated hydrogen producer rather than just a hardware seller. The recent movement has been defined by a series of higher lows on the daily chart, which is a classic sign of accumulation. We've moved past the crucial resistance at $2.60, and the stock is now testing the psychological $3 level as new support. Institutional activity shows that while some major funds have trimmed their positions, others like Kovac Advisors and Use of Capital have been quietly nibbling at these levels. This isn't the reckless buying we saw in 2021. It's a calculated bet on the path to profitability narrative that the new CEO, Jose Luis Crespo, has been pushing since he took over in March. He's been on a non-deal roadshow in Canada and Europe, specifically targeting institutional investors to explain how they will reach positive cash flow by late 2026. The market is skeptical, and rightfully so, but the trading volume tells us that the skepticism is starting to lose its momentum. When you open your Robinhood app or check your individual brokerage account at Fidelity, you'll see that the sentiment is still largely hold. But if you look deeper into the Fidelity trading platform or interactive brokers fee structures for large block trades, you can see that the smart money is preparing for a catalyst. That catalyst is likely the May 11 report. If they can show that the cash burn has actually decreased by the 26% they promised, the shorts would be forced to cover. On the other hand, if they miss their margin targets again, we could see a revisit to those sub-$2 levels. It's a high-stakes game of chicken. Investors using platforms like SoFi Invest or those looking at Fidelity ETFs often see Plug Power as a lottery ticket, but the reality is that the company is currently functioning as a high beta proxy for the entire green energy sector. When the sector moves, Plug Power doesn't just move, it explodes or implodes. Let's talk about what the company actually does for a moment to ground this analysis. Plug Power builds the entire ecosystem for green hydrogen. They make the electrolyzers that create the fuel, the storage systems to hold it, and the fuel cells to turn it back into electricity for forklifts or heavy trucks. Their GenDrive systems are already running in over 280 sites globally. This isn't a startup in a garage, it's a massive industrial operation that has shipped over 300 megawatts of electrolyzers across 6 continents. The problem has never been the technology or the demand, it's been the cost of making the hydrogen. For years, they were buying hydrogen at high prices and selling it to customers at a loss just to prove the concept. Now, they are finally bringing their own production plants online. They recently finished a 100 megawatt installation in Portugal and are ramping up sites in Georgia and Tennessee. This is the reality that is starting to challenge the expectation of failure. If you are using a Fidelity mobile app or an interactive brokers platform to trade this, you've likely noticed the extreme volatility during the midday sessions. This is partly due to the fact that the stock is a favorite for retail traders on the Robinhood app, who use Robinhood fractional shares to play the swings. This retail interest creates a lot of noise, but the long-term trajectory will be decided by the institutional desks at firms like Fidelity Wealth Management or Schwab. They are looking at the $132 million asset sale to Stream Data Centers as a sign that Plug Power can fund itself without more soul-crushing dilution. They are also watching the legal landscape, as several class action lawsuits have been filed recently regarding past disclosures. This is a significant risk that the reality must overcome. I want to pause here and ask you, do you think hydrogen will actually replace diesel and heavy-duty trucking by 2030, or is it just a niche solution for warehouses? Comment below with your thoughts on whether you think the government should provide more subsidies for hydrogen infrastructure. The future outlook for Plug Power hinges on one word: execution. The expectation is that they will continue to miss their own deadlines. The reality we are seeing is a company that is finally hitting operational milestones, like the Fed contract for the 275-megawatt project in Quebec. If they can successfully navigate the next 2 quarters without another going concern warning, the valuation could re-rate significantly. However, the risks are real. If interest rates stay higher for longer, the cost of financing these massive hydrogen plants become prohibitive. Also, the competition from companies like Bloom Energy is heating up. When you look at the SoFi active investing charts or the Fidelity mutual funds that hold these stocks, you see a sector that is searching for a leader. Plug Power is trying to be that leader by owning the entire value chain. The trading volume today suggests that the market is waiting for a reason to move. We are seeing a consolidation pattern that usually precedes a major breakout or breakdown. For those doing online investing or looking for the best investing sites to manage their individual brokerage, the key is to watch the margin expansion. In the last report, they achieved a positive gross margin for the first time in a while. If that trend continues, the narrative changes from "can they survive" to "how big can they get?" This is where the tension between expectation and reality becomes most profitable for the disciplined investor. Most people are expecting another disappointment, because that's what Plug Power has delivered for years. If the reality is even slightly better than bad, the stock will likely react violently to the upside. In summary, the situation with Plug Power is a classic case of a beaten-down sector leader trying to prove its business model actually works at scale. We started with the live price of $3.17, which reflects a cautious but growing optimism. We've looked at the institutional activity on platforms like Interactive Brokers and Fidelity, and we've analyzed the shift from hardware sales to integrated hydrogen production. The expectations are low, which provides a massive opportunity for a reality beat in the coming months. Whether you use Robinhood Crypto or SoFi stocks to balance your portfolio, Plug Power remains one of the most polarizing and important tickers in the green energy space. The contrast between the narrative of a failing pioneer and the reality of a global infrastructure provider is where the true value lies. We'll be watching the May 11 earnings call very closely to see which side of that tension wins out. As we look toward the end of 2026, the catalysts are clear: the completion of new production plants, the stabilization of the balance sheet through asset sales, and the potential for a massive short squeeze if the earnings data surprises to the upside. The risks, however, remain tied to liquidity and the ongoing legal challenges. It's a high-wire act, and the management team is walking it with more discipline than we've seen in years. Whether you're using Schwab Intelligent Portfolios or managing your own trades on the Robinhood app, the key is to stay focused on the data rather than the noise. The hydrogen economy is maturing, and Plug Power is right at the center of that transition, for better or for worse. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.